Yep. Good morning, Nighthawk. Yeah, Red Apple may have just not that it's Apple's fault, but Apple may have just put the next nail in the coffin or shown us that the market is fine. So today may be one of those days that you look back on and go, yeah, that was kind of the day we all died. Possibly. So Apple basically saying, for those of you that don't know, um, China's killing us because growth is slowing down in China. That's not good. That's not good at all. And so that's probably one of the main reasons why this market's been selling as hard as it has been. Um, Another thing that is just as important, in my opinion, is Ray Dalio yesterday put out a letter, and I'm still kind of working my way through it, digesting it and everything. Yeah, well, this being a super news-driven market these days is not good. Like I said, if it kind of shakes this off and everything but the Apple sector, because Apple's its own sector essentially. If it shakes it off, that's good news. That's good news. But I don't really see that as very likely. Okay, so hold on a second. Let me go to my LinkedIn page. That's where Ray Dalio placed his article, and I think this is just as important. Hold on a second here. The heck is this? Okay, hold on. Ray Dalio. Huh? He's not on LinkedIn? Come on. It's on my phone. I don't have it on my computer yet. Bad timing with the whole government shutdown talks today. Well, there's not always bad news, but it does suck when they compound on each other. That's funny. All right, hold on a second. It's probably in my email. There it is. Yeah, it's on LinkedIn. All right, I'm going to post this link in the chat for you guys. Didn't post it? Edit and try again. Yeah, Apple screwed everything. Shoot. Maybe just Googling this will help. Yeah. Here you go. Just Google that. It'll bring up the article. It's the first link. At least it is for me. Google changes things for everyone, but it's a LinkedIn link. It's a long article. Ray Dalio tends to talk like complete geek, which is fantastic for me because I'm a complete geek. And it puts, I'm almost done with the article. I need to get down. I'm like 80% done with it, but I need to finish it. Anyway, that is going to be BMS bought Celgene. Really? That is interesting. Anyway, read that article. I don't know if it means... I actually was planning on going through this article, but now with the Apple news, I think we should watch the market. So let's see what the market did yesterday. Apple looking okay yesterday. Volume's a little bit light. The NASDAQ, the volume on the Qs wasn't elevated from what I saw. So there's the Qs. We were up a little bit, but really not that much. So definitely no follow-through day. 74 billion, huh? That's amazing. What's that per share price? I'm going to look it up on FinViz on my other screen here. They were at 48 billion yesterday. They bought them for 74. Wow. That's over $100 a share. They're at 66. Because they have 719 million shares. So easy math there. 74 billion would be a little over 10 times that. Wow. Well, good for them. Again, so yeah, we're gonna see if the news about Apple overnight is gonna send. I think that's the reaction on the news right there on the Qs. And right now we've come back a little bit, quite a bit of volume here too. We'll see. Although I'm sure if I normalize this, it's not going to be that much volume, but we'll see how this goes throughout the open. But the Ray Dalio forecast is very interesting. I do want to dig into that. Maybe we'll watch the market open for a little bit, and then I do want to dig into this. If you guys have not read any Ray Dalio stuff, you should. The guy is super smart, and him sharing his view on world markets, which has made him successful for the past, I don't even know how many years, 40 years. The past biggest hedge fund manager in the world before there were hedge funds, there was Ray Dalio. And then everyone else caught on because Ray Dalio was successful. And then now he's not giving the secrets away, but he's sharing his economic model. And it's pretty cool. And if it's accurate, then we have a lot of work to do. I don't mean chart-wise, I just mean generally in terms of understanding where these economies could be going, how they affect asset prices, which is, I mean, he's a hedge fund guy. He's not just some academic, guy that looks at numbers all day long and doesn't actually have to be right about a position. He has to be right on his positions. He's Ray frickin' Dalio. He manages like $161 billion. So, and the guy seems like a genuine guy. I don't think he's out there trying to mess with people. He doesn't really tell you to buy or sell stocks. What he tells you is he tells you very broad economic theory, which so far has proven to be fairly accurate. So, our market's 2 minutes to the open. We're poking higher here on the Qs. Look at the NQs. Also poking higher on the NQs. You see right there's the reaction to the Apple news right after the futures closes. Looks like when they announced it. There's no other reason for that to drop that far. But as you know, Apple, one of the largest companies in the world. Also, there's a lot of supply chain companies that are going to be affected by this and probably are going to sell off in concert with it. The Apple ecosystem, I called it earlier. I don't know all their names, but they're broad and varied. Well, not too varied. They're mostly chip makers, screen makers, component makers. I don't think too many wood lumber people are going to have problems. IBD says Apple cripples global tech stocks. So absolutely they will. We'll see if this little rise continues, or we'll see if this gets sold off into the open. But our NASDAQ yesterday had a pretty good day. Wasn't great, but we definitely closed pretty decently off of the lows. Kind of had a decent volume too. Volume was pretty good. Not too much selling in the afternoon session. There was some, but it wasn't a tremendous amount. And then obviously we had the big sell because of the Apple news. I think just as some investors were starting to feel a little bullish, this is going to knock the wind right out of you. Yeah, I don't know what's really good about that. All right, so a little bit to the market open. Gold hit 6-month high. Let's look at some GLD. Gold's been hitting highs for a minute. All right, markets open. Let our world be changed with the ringing of a bell by some white people. All right, so let's watch this. See what happens. Take a look at Apple. We got Celgene up 31% today. $87 apparently is where they're going to buy that out at. INSG, Goose up a little bit. Lilly, INS flat. AMED flat. Tesla down a little bit. Twitter down a little bit. VMW down a little bit. Tesla down a little bit. Tesla had a decent day yesterday. That's not a bad day. Bouncing off of 300. Not a major up day though. Didn't really close super positive. What else is up here? Nettie's down a little bit. Team down a little more, 2.54%, backing away from the buy point. Never really did have a breakout. Never did close up there. Never did have great volume. Stream's not working. Appears to be working on my side. I have sometimes my streamer can go black. It's happened once in the past, and I get a black screen on my streamer. Sometimes my audio goes out, and I don't get audio notifications. I've got both of those right now. All right, what's down here towards the lows here? We got Apple down. Apple down a ton. This is definitely going to put pressure on the NASDAQ, but yeah, if we get a nice day today and it's going to buck off this news, that is definitely positive for the market. If. Let me say if a few more dozen times. So positive 2 minutes does not a good day make. Reconnect once, huh? That's weird. I don't know if that has anything to do with me or with YouTube. YouTube's the intermediary there. I don't really see any difference in my stream when I start it to when I stop it in 99% of cases. All right, so good reaction so far. Wait and see. This may be one of those days you want to wait till the market close. But just the fact we're not just completely tanking on this news is slightly positive. Is slightly positive. I was actually running in here like, oh crap. All the positions I've taken. Do I have to sell everything now? Because that could be bad. Really? Every time, TA, huh? Wow. If anyone else has that problem, let me know. I'll research if there's anything I can do. I really don't have a resource of calling YouTube, unfortunately. Yeah, Celgene's gonna. I'm just gonna take Celgene off my list. No reason to have Celgene on there. Regeneron bouncing on similar news. That's a big acquisition. What do you say, 74 billion? Yeah, 74 billion. That's a huge acquisition. That's a big one. That's a biggie. Just mentioned gold. Gold has been moving higher. They're taking quite a few defensive positions. If gold is really getting this high, then then they're thinking gold is usually an inflationary play, in my, from what I've seen. Also, sentiment, inflation. There's usually it's a fear play. Gold is a fear play essentially. If you think the economy is going to go weird, you think gold is going to be a savior. Well, so far, not too bad. Definitely elevated volumes up here. Starting to see some selling. Oh, there you go, TA. What do you do there, TA? I have no idea what BM... Oh, is that Bristol Myers Squibb? BMS? Oh, it's BMIS. I don't know. I don't even know what BMIS does, to be honest with you. Let's look on Finviz. I happen to have it up on my other screen. Probably don't think BMS bought them. Probably Bristol Myers. BMY. BMY is Bristol Myers Squibb. Yep, bought Celgene. Videos. Okay, cool. Bristol Myers Squibb buying Celgene. No wonder they're down 12%. Anytime you do those kinds of acquisitions, it doesn't usually end very well. Yeah, another thing I thought was interesting here is it says, as rare forecast cut by Apple. I don't know why they felt the need to do kind of a mid-cycle announcement about this, to be honest with you. They have earnings coming out, late January, so 3 weeks from now. I don't know why they felt like doing it now. It's probably kind of a fiduciary responsibility on Tim Cook's part, but all right, so I want to go through this Ray Dalio article a little more in depth. It looks like I've read actually almost all of it. So I'm down to this part here, the 2 levers that governments have to help bring these equilibriums. It's pretty dry. Sometimes I even have a little bit of I'm not an academic guy by any stretch. So I don't really struggle, but I have to pause a little here and there to, really try to see what he's saying. He uses some pretty highfalutin language in a lot of instances, like reducing debt service burdens. When you think about it for a second, you're like, okay, yeah. But reading it on the first initial boost, if you're like, oh, that's pretty technical language for money. So, but he talks really good about the economy here and makes sense of makes sense of a lot of things. And this is actually a much more better put together article than I've seen him do in the past. So I definitely recommend reading this. I posted the link in the description. Just Google that term, and you'll get this article. But let's go through these. So this is the end. Let's read these last paragraphs. I haven't read these yet. In the short term, policymakers' use of these levers can either keep economies away from these equilibria if they act too slowly or inappropriately, or can help speed up the adjustments if their actions are timely and appropriate. Understanding these equilibria and levers is important to understanding the market and economic cycles. By seeing which equilibria are out of whack, one can anticipate what monetary and fiscal policy shifts will occur, and by watching these shifts, one can anticipate what the changes in these conditions will be. I hope this explanation of my template and what is happening right now in light has helped you put things in perspective, and more importantly, will help you independently put things in perspective in the future. So I really highly recommend reading this entire article. It's a good read. It's a really good read, and he goes through almost his entire. He's got a 30-minute video too, and he has links to all of his stuff. It's all free. So at the biggest picture level, this is kind of introduction to Ray Dalio for people. This guy's a super economic nerd and makes money while being a super economic nerd. So he's kind of the best of both worlds. How the market and economic machine work. At the biggest picture level, there are 3 big forces that interact to drive market and economic conditions over time. Now keep in mind, he does say drive market and economic conditions. Again, this guy's a hedge fund guy. their productivity growth, the short-term debt cycle, the long-term debt cycle. These geopolitical these factors also affect geopolitics both within and between countries, which also affects the market and economic conditions. So he goes into these. The short-term debt cycle takes 5 to 10 years. The long-term debt cycle comes once a lifetime, 50 to 75 years, which is why a lot of people don't see him creeping up. So he goes into explaining productivity growth, explaining credit and debt cycles. He goes into explaining the short-term debt cycle. He's a real educator. He's a good guy. Long-term debt cycle. And I'm just going to kind of point out the highlights for you guys. For all the previously described reasons, the period that we are now in looks a lot like 1937. We've seen a lot of parallels. IBD said we're like in the 1950 or in the beginning of the 1980s. It looks like Ray Dalio may actually be more correct. Look like 1937. So I mentioned politics. He goes into politics a little bit. He doesn't stout for red or blue here, but talks about populism, which we're in the middle of right now, which is another reason why he thinks we look like the 1937, because populism really led to, and he's not calling anyone Nazis, but really led to the populism movement of that time really led to Germany rising up and everyone kind of rising up against Britain. And he sees a little bit of people rising up against the U.S., China mainly. And he's a big proponent of China. He's been in China for the past 20, 30 years. I thought this was interesting that I hadn't really heard him talk about this before, but again, his stuff's almost like reading a white paper on economies when you read any of Ray Dalio's stuff, so you may have to read it a few times. The three most equilibria are, here you go. At the big picture level, there are three important equilibria that must be achieved or big changes will eventually occur to lead them to adjust toward these things being in equilibrium. Governments have two levers in order to push them towards equilibrium: monetary and fiscal policy. Okay, by understanding the three equilibria and the two levers, and by understanding how they influence one another, you can pretty well see what will come next. Three most important are the debt growth. Okay, is it in line with income growth that is required to service the debts? In other words, if everyone's monthly payments go up by $40, are they making $40 every month? Otherwise, the debt itself isn't a problem. All right, otherwise it is a problem. The utilization of the economy's capacity is neither too high nor too low. So too much spare capacity, it's a painful set of economic conditions. Over time, it will spur unrest and monetary policymakers to act to improve conditions. Too little, it creates undesirable inflation pressures. Okay, so if everybody wants your widget and everyone's calling you for a widget, you're going to start raising your prices, which causes inflation. And then 3 is the projected return of cash is below the projected return of bonds, which is interesting because they'll essentially just start buying bonds. So, which is below the projected return of equities by appropriate risk premia. Again, another highfalutin word right there. These spreads in expected return are important for healthy functioning of capital markets and the economy because they create incentives to lend, borrow, and produce. So he goes into that. I'm not a super big bond guy. I probably should get better in bonds. I'd probably be better overall. So he talks here about the size of the spreads between the expected return of cash and the expected return of risky assets will determine how much capital will move where and drive the movement of money and credit through the system. In fact, most financial decisions are made by financial intermediaries trying to grab the spread. I thought this was interesting, and I never really thought of it in those terms, and is therefore a big driver of credit growth, asset class returns, and economic growth. So in other words, can you borrow and then re-lend that money, which is essentially what big banks do. If you guys know about the Fed window, the Fed has a window where like 6 big banks can go to and they borrow at the Fed rate, and then they re-lend that to secondary banks. And then they in turn re-lend that to you and me in most cases. So if you can go to the Fed window and right now get a rate of 2.5%, you're going to go ahead and re-lend that to your regional bank, say 3.5%, and then they're going to go ahead and lend you your signature loan at 12.5%. So as long as that spread is okay, then everything's cool. Bye, babe. And then the two levers they have are monetary policy. I'm sure you know what that is. He talks about buying assets, and he talks about the buying assets and quantitative easing, which is, lending money and buying assets. And then fiscal policy, which is kind of, this is where I don't think I finally finished this. I kind of trailed off in here. So by reducing interest rates, central banks can stimulate by reducing debt service burdens, by making it easier to buy items on credit, and by producing a positive wealth effect. He talks about the wealth effect above. When the short-term interest rate hits zero, central banks go to quantitative easing, which is monetary policy too, in which they buy bonds by printing money. This form of monetary policy works by injecting liquidity into the system, as well as pushing down the spreads on bonds relative to cash, which can drive investors into riskier assets and produce a net wealth effect. Monetary policy, too, is most effective when risk and liquidity premia are large, but its effectiveness is diminished when spreads between assets are low, because at that point they cannot be pushed down much further so as to produce a wealth effect and to induce people to spend. At that point, central banks can target stimulation at spenders directly instead of investors and savers. Monetary policy 3, and we saw this in the Obama administration. I think, or maybe I don't know if it was late Bush or early Obama, where we basically got a check from the government by providing money to spenders with incentives to spend it. For more complete explanation, see Principles for Navigating Big Debt Crises. Then he talks about fiscal policy, where governments can impact through their spending on goods and services, taxation, legal structure, and things like that. So super cool article. And Ray Dalio thinks we're like 1937. And I found an interesting article. I did a little bit more digging into that. See if I can find it. Morning, Eli. I did see you there. Buy the dip. I don't know about that. I'll let the market prove itself right here. An Apple article, like an Apple news event like that, scares me. Not a lot of things scare me in the market, but I don't know if you heard, but Apple basically said, hey, we're slowing growth. China's hurting us. Forecasts are going to be lower. That's basically what Apple said in a nutshell. So that drove the price lower here after market, and then so far we're holding okay, but that's just so far. Yeah, I figured, but you never know. Hold on. All right, I'm back. Well, if you're short of them in July, Eli, you'd have had a bad August, September. So yeah, I don't remember the crux of the conversation, but so anyway, so Ray Dalio thinks we're in 1937. And I don't know enough to agree or disagree with him, but I was trying to find an article that I was reading yesterday. I'll do it off screen. I don't know what other weird stuff I have up here. Nothing much, but okay, here you go. So Ray Dalio talked about this also in 2015. So it looks like in 2015 he talked about the 1937 scenario. Again, this is a hedge fund guy. This guy's super good at what he does. Mention reference to 1937, and this guy put together the next 10 years in the market. So at 37 we were down 35% in stocks. Bonds were up 1.38%. The next year we were up almost 30%. Next year we were flat, down 10%, down 12%, up 19, 25, 19, 35, for a net adjustment gross of 3.58% from 37 to 46. So I started doing a little bit of my own research. I mean, it's not super extensive. I'm just trying to find stuff that I thought this was interesting. A 100-year chart. Actually, I actually didn't think this was interesting. I didn't really. It's not good enough for me to make head or tails of it in terms of these market swings with the numbers. Trying to make sense of what Dalio plus this. So this goes back to 30. This would be 37, where they started raising rates, or I think. Or actually, this would be 37, where they started cutting rates. So this is the Great Depression. They raised rates too soon, and then they started cutting rates again. And this is the choppiness in the market, I guess, from 37, wherever that ends up being. Again, it's not a very good chart. And then this is the 100-year chart. And the scroll bar never works. Oh, I can do that, I guess. So in 1937, negative 32, so 28, and then you see here for the next foreseeable future, a couple of really bad years. Now this is probably just due to, according to Ray Dalio's theory, the monetary policy of 37, and he says they kind of mismanaged it. So there's a possibility that we manage it better this time. That. The way the Fed's looking, they're raising rates. I don't know. We'll have to see. I'll have to do a little bit more research on what they did versus what we're doing today, exactly like quarter by quarter. I'm sure that information is out there. But you can see here it says there were 5 difficult stretches that saw stocks fall 36%. Over the following 5 years, they were up 120%, or 17% per year. It led to just a 3% annual return. So that's annual return, not net gain. So 3.5% annual return over the next 10 years from the 37 market cycle. So if our monetary policy makers don't adjust things appropriately, this is what Ray Dalio is saying. If they don't adjust things appropriately and use their tools wisely, we could end up with a very stagnant return overall in the market. And so the possibility of our good economy leading to subpar stock market performance is real and is upon us. I was thinking that our economy being good, we would at some point return to equilibrium. Apparently that is incorrect. It doesn't have to happen that way. So, and I didn't read this guy's article. I really just wanted to, I did see this though. This is where he's talking about Ray Dalio. People talk about Ray Dalio said the world's going to end. But he says, I doubt many headline readers or writers bother to read his entire piece. And a lot of people don't because it's kind of a difficult read for most people. We can tell you what happened when the Fed tightened in 37, but we can't tell you what will happen when the Fed tightens this time around. And I think that depends on how the Fed tightens. Ray Dalio is actually someone that people call upon. I don't know if this Fed will or has or does call upon Ray Dalio. But all he does is provide their economic models. He actually uses his platform to speak to world governments about monetary policy because as a person that manages money, he has to get things correct where a majority of economic leaders don't. They just have to get the office. That's their job. And then everyone else deals with the result of their whatever they decide to do. So I thought this was interesting. These are the stock market returns from 1937. And, what Ray talks about in this article, this is what, so blah, blah, blah. There's a section I'm trying to find. Hold on a second. All right, here we go. Found it. As I was blowing my nose, a twofer. I got a twofer, guys. Okay, I won't read the whole thing. Well, wait, screw it. I'll read the whole thing. Let's see what the market's doing. And we're falling a little lower here. So maybe in a topping situation. This whole area may be topping. So short-term debt cycle lasting about 5 to 10 years. In the cycle that we are in now, the expansion has been so long because it came from a very depressed level, because 2008 was so deep, and because growth in demand has been relatively slow because of the debt crisis hangover, because of the growing wealth gap and spending of those with a lot of wealth having low propensity to spend. And this is money going to the rich right there. We talked a little bit about this the other day when I talked about the Trump taxes coming in and going to the corporations after like one or two circles around the economy. That's exactly what he's talking about here. Wealthy people don't spend. When slack is reduced in financial and credit finance spending, growth is faster than capacity. Early in the cycle, that leads to price increases until the rate of the growth in spending is curtailed by central banks by credit tightening, which happens late in the cycle of the short-term cycle where we are now. So now demand is strong. And so this is the interesting part about our strong economy. At that time, which, like he says, we are there now, demand is strong, capacity is limited, and profit growth is strong. Also, now, the strong demand for credit, rising prices, and eventually central banks tightening of monetary policy to put the brakes on growth and inflation causes stock and other asset prices to fall. They fall because all investment asset prices, this gets a little weird, they fall because all investment asset prices, they fall because all investment assets are priced as the present value of their future cash flows at their present value of their future cash flows. So the stock market is a forward-looking instrument. When you hear me talk about that, this is exactly what it is, okay? Because assets are priced as the present value of their future cash flows. And interest rates are the discount rate used to calculate present values. So the higher the interest rates, the lower the asset price present values. So there's the dichotomy here. And this kind of threw me for a loop. I'm like, whoa. So I even read some Ray Dalio, and I, kind of did this. But they fall because asset prices are valued by their future cash flows, and the interest rates are the discount rate used to calculate the present values. So the higher the interest rates, the lower the present values, which is why they fall, which is why we're falling. Also, tighter monetary policy slows prospective earnings growth, which makes most investment assets worth less. For these reasons, it's common to see strong economies being accompanied by falling stock and other asset prices, which is curious to people who wonder why stocks go down when the economic and profit growth is strong. And he says it's because they don't understand how this dynamic works. And this is where we are now in the short-term debt cycle. That to me was the crux of this whole thing. That to me is the crux of everything. And so he has models based on all of this stuff. Like every time they learn new information, he was one of the first ones, I don't know if he's like the 5th or the 90th, but one of the first ones to algorithmically put all of this into a model. So he has all of this algorithmically going into the model, and he's actually been hurting a little bit since 2015 because in 2015, via this other article we looked at, this came out in March 2015, about almost 4 years ago. We've been booming for those other 4 years when his model says we should be going into this type of an economic situation. So he's been like the first time ever, I think he's been hurting or at least underperforming in his portfolio. But it's finally coming to pass, and things can take a while actually to start to things can take a while to get to the point where we are finally falling. And so I think that is anyway, that could be where we are now. So turns out the Fed tightening has less to do with what I was talking about the other day. Remember when the Fed thing happened, and I think we were up here when the Fed thing happened, and I said, the market's just bitching. What's wrong with 2.5%? Things of that nature. So apparently, I'm wrong. Ray Dalio is right. I'd much rather you listen to Ray Dalio than me, especially on those types about those types of things. So, anyway, that's that. I thought that was really interesting. I'm gonna go I need to do some more studying on that. I really do. I need to do more studying on that. I think that understanding that can make you so much money in the market. Ray Dalio, if you don't know his story, he started kind of like Warren Buffett, managing a little bit of money, turned into a lot of money. I think he manages 160, like I said, about 160 billion. Bridgewater Associates. So about 102 billion according to Wikipedia. I thought it was a little more than that. Okay, Bridgewater says 150 billion. So, yeah, they manage about 150 billion, and they've been doing it since 1975. That's when Ray Dalio started it in his apartment or house or whatever he had at the time. So Ray Dalio, super, super good guy. Really nice of him to do this, and really, he talks about in his book Principles. He's at the stage of his life where he wants to give knowledge away, what he's learned over his lifetime, and so he's doing that. And that's part of the thing. He's got a couple of books out. They're like $10 on Amazon. It's stupid how cheap they are. Even the physical copy's $10. So that's where we are. A lot more work needs to be done, I think, to really fully understand. And we just had a decent little break there in the markets. I'm not super happy with that. I don't like the Apple news by any stretch, to be honest with you. So let's see what's working, what's not working today. Get back to the charts. So we got TZA up some here. There's the 3 times short the Russell 2000. You got a couple of weed stocks, RGRMF, rallying pretty hard here today. So that's good for the MJ sector. Tilray up 2%. Hasn't really fully broken down from that little bear flag. Actually, yesterday with a little bit of a support day. We'll see what happens here. But the general market's starting to break lower. That I'm not too happy with. BIIB, probably up on the merger news. That'll probably give way soon. AMC, Huya. Still, we haven't looked at Huya in a while. Looks like Huya's still downward trending. Tried to break that trend line right there. Did for a minute and then stopped. Actually, here looks like we have a bit of a higher low in Huya. This actually, if the market wasn't so deep in a bear market, I almost would think about taking a position here. Let's blow this up a little bit. Eli, you may slap me on the wrist for this a little bit. Please do. Please feel free to. If this were a crypto, and I do a lot of charting on crypto too. If this were a crypto, I'd be a little intrigued by this one, the low and the slightly higher low setup. Now, being that it's a stock, it may react a little bit differently, but looks like the momentum's waning a little bit to the downside. We're getting a little flatter. I don't think that the trend here has maintained as well. You can see the trend of the downward movement there. That doesn't quite touch. That definitely is a gap. And if this is our next low, there's a huge gap there. We never even undercut that prior low. So Huya, maybe lower risk entry here. Wow, that's still 8%. 7 3/4 to 8% risk on the table. Doesn't seem like it would be that high, but apparently it is. But Huya down here, if for whatever reason things can get going good for Huya, so anyway, at this stage of the game, this would probably be your proper buy point for Huya, but that's actually not a horrible looking chart. Volume declining as we're kind of maintaining the lows, so that's half positive. Anyway, that's interesting in Huya. ENDP, EVR, that's Tilray, not EVR. EVR jumped on me. Man, my window's dumping some cold air on me. So TQ's dropping down here. I probably wouldn't take that super light, to be honest with you. Volume a little bit elevated there. What about Volkswagen? Well, in this market, I wouldn't be touching anything with a 10-foot pole. VW, that symbol didn't pull up anything. Is it VW? Come on, give me my search thing, man. No. Come on. VOW? I don't get VOW either. VW AGY is Volkswagen AGR. Okay, we're on different platforms then, buddy, because this Thinkorswim, if you look at what is VW, Justin? Tell me what it is. Oh, Volkswagen, the 44 billion electric car plan. Well, that's fine. Let them execute that. Volkswagen. VLKAF is what I got here for Volkswagen. Although it looks like it's an over-the-counter thing. So here's the thing with with stock trading and stuff like that is, hold on a second. When you have something big like Volkswagen, they need something else just as large to get them going further. I don't know if electric cars for Volkswagen are necessarily going to make them that much more money. As a matter of fact, spending $44 billion seems like a lot of R&D, which may actually hurt them in the shorter term until they get that plan going. So I think you have to, take that with a little bit of a grain of salt and wait for good setups to occur. Okay. Yeah, so I'm not. Man, my window's putting off some cold air today. Oh, we froze overnight, didn't we? Yeah, I think we had a freeze warning overnight. But yeah, so I wouldn't. You could keep an eye on it, but I wouldn't be super into it, to be honest with you. I mean, the only guy Tesla really has the first mover advantage, the quality advantage, a lot of advantages. I don't think they should have raised their prices like they did, or lowered their prices. Excuse me. That's my opinion. Their money guys probably battled over that for a while, so I'm sure they made the best what they feel is the best decision. I'm just a guy talking about charts. I don't know much about that, but I don't know. I think that was a bad move. They're still in a growth phase. They don't need to be cutting prices like that. They still have, like I said, the first mover advantage. They have the cachet that comes along with owning a Tesla. I just don't think they needed to do that. All right, what's down today? Let's see what's down. We got Apple down 9%. We got Solar Fun, Carvana down a good amount. Save, oil must be back. Skyworks, oh wow, look at that on Skyworks. I didn't notice that. That's down huge, all the way down for a long time. Save Roku, I just bought one of those for a client yesterday. They didn't pop on the news. I bought one Roku for $60, and that didn't pop? Are you kidding me? CRISPR. Yeah, this could be one of those good times to go SQQQ long for the next leg. To be honest with you, the way things are going. I mean, look at this. We're elevated. We were closing highs up here. We were closing around the same level, and that all changed yesterday. I think the Apple news probably leaked a little bit early. But then, this morning we dropped lower. But as of late, when we've been in these elevated levels, it's been advantageous to short as you've actually broken through these levels, at least for a leg down. These legs have been a little smaller. This one was larger. I don't know if we're going to get a leg here or when we're going to leg here. We'll see. So maybe undercutting above yesterday's lows probably would be the thing to do, maybe. Which would be here. Right down there. So 6,200, maybe something like that. What do they have here? They got 6140. Oh, this is the NQ, that's why. 6147 is way lower. Yeah, so maybe under today's lows, 6188 if it gets down there. Something like that. Volume already fairly elevated. Not too bad, but fairly elevated. All right, CRISPR, Roku, Silica, TTMI, HCC. This was our coal play that was doing really well. Looks like it's starting to roll over. ALK. Ooh, another Alaska Airlines. Really moved lower after kind of breaking higher in late November, it looks like. Rolling over in early December. TNA really taking it on the chin here. It's down a lot. This is 3 times the Russell. It's down, it looks like 63%. 63%. And there we go, dropping lower. They tried to rally, couldn't do it, just dropped. But yeah, TNA down huge over this market here. Okay, Square, what's Square doing? Square still deep in a downtrend. Haven't actually talked about Square in a while. Square still struggling with that trend line right there. Let's take a few of these trend lines off. Looks like here's a prior low, could be support level for Square, about the $43, $44. We'll have to wait and see if and when we get down there. Looks like almost like a falling wedge a little bit in Square. It's a pretty modest sell-off. I mean, in terms of its pattern, I don't think it's too bad actually. Chesapeake Energy, Micron, Boot still not looking good. RTEC, Hertz, MDB, SOI. Oh, you know, IBD had an article that I wanted to look into for a little bit that talked about some IPO base. Can it break out? I'm like, well, probably not after today. I don't see it here. Looks like they posted more articles since they told me about that article. Oh, bear markets form in waves. Interesting. First wave, second wave, third wave, fourth wave. Day 4 follow through. Interesting. IPO base. Hi, James. Hi, boys.
Can you fix this? Ethan, this.
Oh.
Ethan, I twisted his head.
Hold on. All right. I'm back. So, looks like continuing moving lower here. That Apple news, I mean, in reality, should be kind of the death blow to this, I think, in all honesty. Again, that's just an opinion. Don't know if it's actually going to work out that way or not, but it really is kind of the death blow. So, all right, guys, I gotta get out of here. All right, 8:13. Gotta get ready for real crypto. So I'm gonna bounce. If we don't reverse here, it could have a really bad day. I mean, that Apple news isn't too good. Some of that may have been baked in. I'm pretty sure some of the big boys already had some of that in their models, but I'm sure a lot of people did not. Could cause some selling today. Keep an eye on the volume today. If it's really highly elevated, we're going to have that other leg lower. If you remember the other day, we went over a IBD article stated that these big days like this usually lead to lower stuff. He sells all his positions. Well, I'm selling my TQQQ position, which I got back into. I'm basically flat on it, which was fine. I'm going to go short a little bit, and we'll see what the market does from there. If it reverses higher, then I'll get out. But that Apple news seems pretty damning to me, not just because of the headline, but what it implies across the market. Apple affects so many suppliers. Also, it affects, it talks about like 3 or 4 different large things. Number 1, Apple. Number 2, its suppliers. Number 3, China, and global weakness, and what is the most important growing economy. So, pretty bad, pretty bad. All right, guys, I gotta get out of here. Get ready, put my newsletter together. Get ready for Real Crypto. Thanks for joining me today, guys. See you guys tomorrow. Have a good day.